Welcome to Intermediate Accounting and our discussion of adjusting entries. I know what you're thinking, can't we just skip them? Adjusting entries are necessary because they help our financial statements to be correct. Specifically, they help the balance sheet and the income statement to be correct. Most adjusting entries are necessary because things take place, assets get used and expenses get incurred, revenues get earned over time. And it's those adjusting entries that update our accounting records or our books for those things that happened over time. For an example, assume that, jump ahead into the future. You're working and you're thinking about what your car might be worth. Maybe you're having that mental decision of whether you should buy a new car or not. You're thinking you bought that car 4 years ago, it cost $20,000, and you estimated that it can be used for 20 years if that's what you want to do. Well, 4 years have passed. Is that car still worth $20,000? Of course not. Over time, its value goes down. We know that that's depreciation expense. Well, how does that journal entry get booked? Every day we don't record the usage of 1 day's worth of a car. So what happens is at the end of the accounting period, whether that period is a month, a quarter, or a year, the accountants record the adjusting entry for the usage of that car or that asset over time. As I mentioned, assets that are used in operations over time, like supplies, insurance, prepaid rent, buildings, and equipment, those require adjusting entries for the usage or the decrease in the asset's value. But there's other reasons we need adjusting entries. When unearned revenues are earned over the accounting period, typically evenly over time, the end of the period, we need to record an adjusting entry to recognize those revenues that have been earned. When costs are incurred over time, sometimes these can be things like interest expense that's accruing on a loan, salaries and wages expense that accrues over time as our employees work for us but haven't yet been paid, and bad debts expense that's accruing because we're selling on credit. Nothing specifically happens that prompts us to record these journal entries if we're not making payment. So at the end of the accounting period, the accountant has to think, what costs have been incurred that have not yet been recorded on the balance sheet and the income statement? The last category of adjusting entries is necessary when revenue is earned, but no bill has been sent to the customer. It's typically the act of billing the customer that prompts the accountant to record the sale and the account receivable. But if no bill is prepared and sent, not yet, then the accountants still have to remember to record that account receivable and that revenue. The accountant does so as an adjusting entry. Adjusting entries are needed because one of two things happens. Either the revenue is incurred in a different period than the cash is received, or the expense is incurred in a different period than the cash is paid. When a company incurs a cost, does that create an asset or an expense? The answer to that question is, it depends. The company, when it incurs a cost, which may or may not be paid for in cash, it may record an asset. It would do so if that cost is going to help the company benefit in future accounting periods. Let's take a look at an example. Bruno Mars Company purchases a condo in Manhattan by obtaining a loan from Treasure Bank. So the condo costs $53 million. What would that journal entry look like? Would Bruno Mars Company record an asset or an expense? When the company purchases the condo, they record an asset. Why? Because at the end of the accounting period, the company can still use that building, can use it for multiple accounting periods. And of course, they record the offsetting notes payable. If a cost only benefits the current accounting period, if at the end of the period, there's nothing left to help the company, that cost had been fully used up, then we record an expense rather than an asset. Let's take a look at another example. If Bruno Mars Company rents a beach house in Miami, we see here rent is $90,000 a month. What would that journal entry look like? Well, we see that rent expense increases 90,000. No asset, instead we have an expense. Because at the end of the month, what do we have to benefit the company? Nothing. We have no place to conduct our business. We need to incur an additional cost of 90,000 in order to have a future benefit, which if it used up at the end of the next period would just be another expense.